When we look at investment vehicles, and we talked about stocks, bonds, and cash, those can be owned as individual issues or they can be owned in mutual funds. And there are thousands of mutual funds out there. Four main categories that we're going to discuss are money market funds, bond or fixed income funds, stock or equity funds, and hybrid funds. And I used Wikipedia to help me put these definitions together. Money market fund, investors often use money market funds as a substitute for bank savings accounts, but unlike bank savings accounts, money market funds are not government insured. The other bond or fixed income funds is bond funds are professionally managed portfolios that invest in individual fixed income securities. So those two are in the mix. Next one are stock or equity funds. The objective of an equity fund is long-term growth through capital gains, although historically dividends have also been an important source of total return. Not all stocks pay dividends to their shareholders. Funds which involve some component of stock picking are said to be actively managed, whereas index funds try as well as possible to mirror specific stock market indices, and these are said to be passively managed. Actively managed funds will charge a higher fee than passively managed, and fees are something that you want to consider when selecting your investments. And so hybrid funds is another category. These invest both in bonds and stocks, and these could include what are called balanced funds, asset allocation funds, target date or target risk funds, and life cycle or lifestyle funds. Now when it comes to fund styles, there is two common categories, that's growth and value. So let's take a look at and define a growth fund. A growth company is one that is expanding at an above average rate, much as tech companies did in the 1990s. Catch a successful growth stock early on and the ride can be spectacular, but again, the greater the potential, the bigger the risk. And growth stocks race higher when times are good, but as soon as growth's slow, these stocks also move down rather quickly. The opposite of growth is value. Maybe the company has messed up, causing the stock to plummet. A value investor might think the underlying business is still sound, and its true worth might not be reflected in the depressed stock price. And so here we have growth funds. These funds invest in stocks of companies. Profits are growing and expanding at an above average rate. Value-oriented funds buy companies that appear to be cheap. And let's say, for example, Warren Buffett, who is the primary CEO of Berkshire Hathaway and consistently ranked among the world's wealthiest people, he is noted for his adherence to the value investing philosophy. You can also buy mutual funds based on the size, the company's size, which refers to the market capitalization, how much investors think the whole company is worth. Is $20 billion a lot or a little? No official rules govern these distinctions, but below are some useful guidelines for assessing size. Large cap companies tend to be established and stable, but because of their size, they have lower growth potential than small caps. And over the long run, small cap stocks have tended to rise at a faster pace. When profitability rises, stock prices follow. There are also sector funds. Sectors concentrate their assets in a particular sector, such as technology or financials. The Standard & Poor's 500 breaks down stocks into 10 sectors. Generally speaking, different sectors are affected by different things, so at any given time some are doing well while others are not. In most cases, finance, healthcare, and technology tend to be the fastest growing sectors, while consumer staples and utilities offer stability with moderate growth. The other sectors tend to be cyclical, expanding quickly in good times and contracting during recessions. Now, funds that invest outside the United States can come into three different categories. The first is international. These typically buy stocks in larger companies from relatively stables like Europe and the Pacific Rim. The second basic type is global funds, which do likewise, but they can also invest heavily in the United States. The third is emerging market funds, which invest in riskier regions like Latin America, Eastern Europe, and Asia. And a bit about index funds. These track the performance of market indices such as the S&P 500. They are recognized as passive funds. The fund manager sets up his or her portfolio to mirror a market index rather than actively managing the stock picks. Lower turnover, lower fees. These funds often outperform actively managed funds, an indication that they should be a core component of your portfolio. It's a mutual fund jungle out there. There are thousands of mutual funds to consider. Large company stocks have posted compound annual returns of nearly 10% since 1926 versus 5.7% for long-term U.S. government bonds. Yet while stocks have returned more than bonds, they are also more volatile. Combining stocks with bonds will net you a more stable portfolio.